Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Go to Liz Ann Sonders now, the inflation report here in 4 minutes with John Tucker, and then finish strong with Liz Ann as we can. Full disclosure, folks, in honor of the Los Angeles Angels, we're playing Nickelback at the end of the hour. We're giving Liz Ann a warning.
Turn down your radio if you
turn
need.
it down as
okay.
she chooses. Liz Ann, I want to go to the heart of the matter. And you have had leadership on this in the industry going back to your days with Lou Rukeyser. In the last 10 years, a given blended stock fund is up 12% per year. In the last 10 years, a given blended bond fund is up 2% per year. Inflation is a friend of stock investors, right?
A lot of people think of asset classes like gold as sort of the ultimate inflation hedge. But over the very long term, the only asset class that has consistently outperformed inflation is U.S. equities. So you're absolutely right, Tom.
And where are we now in that continuum? I mean, in honor of pitchers and catchers, Liz Ann, Gura's given us the innings metaphor. Where are we in the confidence to be in equities with inflation and all the other noise?
Well, here's the tricky thing about inflation. When you're in a more volatile inflation backdrop, like was the case from the mid-60s to the mid-1990s, that's an era we've been calling the temperamental era. That was an era when bond yields and stock prices were inversely correlated. And that's because inflation was more volatile. You had bigger swings in inflation. There was more heightened concern about some of those swings in inflation. So for instance, higher yields in that backdrop often meant inflation was reigniting negative for equities. Fast forward to the period from the mid-90s up until the first year or two of the pandemic, the so-called Great Moderation era, that relationship was completely opposite, and bond yields and stock prices moved consistent with one another. And that was because we had very little inflation volatility, not a lot of inflation risk. So higher yields was typically a sign of stronger growth without the attendant problem of inflation. We're back in that negative correlation territory right now. And I do think it could mean we're in a different secular backdrop.
David Gura, squeeze one in here before CPI.
Yeah, Liz Ann, in these data, we're not going to get any indication of what Donald Trump's policies might mean for inflation in this country. But I wonder if we can go back to 2018 when we had the first kind of round of a Trump trade war. What can we learn sort of from that experience that might be applicable here, if anything?
Well, we didn't see overall inflation pick up. You didn't see it in PCE and PCE goods. But if you pull out the tariffed goods and track them in 2018 into 2019, a significant amount of inflation in those tariffed goods. I think, by the way, guys, I think the PPI report might be a better tell in terms of tariff-related stuff than the CPI report.
I took tomorrow off, Tom. I'm not going to be here for PPI.
Crushed. Liz Ann and I are pros. We'll be here. Liz Ann Sonders with us with Schwab. 2.13% is a 7 basis point move there to a higher yield regime. Liz Ann Sonders, it's unfair to go into the minutiae here because, you're doing this in real time and, I understand it. But across the board, a la what Anna Wong said, this is not just one statistic. Month over month, which is what Mike McKee really looks at, year over year. Jason Furman will give us an ecumenical study in about an hour. All inflation boats rise here, don't they?
They do. You're right. The core headline, the month over month, the year over year, the overall headline, all hotter than expected. And it's in keeping with some of what we've seen in inflation expectations. Now, the University of Michigan version of inflation expectations had an extreme divide in terms of along party lines, Democrats having a huge expectation for higher inflation, vice versa for Republicans. But even has gone from 1.9% or so last fall up up to, in the well into the mid twos. So you're seeing it in other areas. And I think it's certainly supportive of what we heard from Powell yesterday, which is they're in no rush to move back to easy policy.
I said the VIX would lag. We just had a 17 print on the VIX up a stick. A stick is Liz Ann Sonders talk for one big figure. I have to use that jargon.
I appreciate that.
Liz Ann here. Even a BitDog down 1,500. BitDog now at 94,000 as well. David Gura and Tom Keene on YouTube. Thank you so much for being with us across the nation in your commute, in your living room and office. Honored to have Liz Ann Sonders with us, Charles Schwab. David?
Liz Ann, let's pull back a little bit here because we see the immediate market reaction. It's something I wanted to ask you about because we had the Michigan survey last week and saw the reaction there. There has been a reaction, dare I say, at times an overreaction to some of these most recent data points. As you look at it more holistically, how is the market processing sort of the broader view that we're getting of the U.S. economy?
Yeah, one of the interesting things, and you're picking this up in some surveys of institutional managers engaging what is driving stocks. And I think we've actually moved a little bit away from things like monetary policy and broad macro trends, and more of the connectivity to what stocks are doing are the specific fundamentals, but there is that policy component too. I think the NFIB data out yesterday was pretty compelling in gauging at least small businesses' reaction to the manner by which we get these tariff-related announcements. And everybody is now trying to dig in using the fine-tooth comb, figuring out which industries, which companies are hurt or benefited on the import side of things, on the export side of things. And I think that's going to come into play more and more at the individual stock level because of that shift to fundamentals and things like earnings, now that we're in earnings season, driving stock prices more than just broad monetary policy or just valuation expansion. So I think that's an important shift relative to last year.
I pull up WIRP here on the Bloomberg, Tom. I see traders shifting their next Fed rate cut prediction to December from September, so pushing it back even farther still.
Well, yeah, but we're the economists, Liz Ann Sonders. I mean, are we ready within the stock market, Liz Ann, for the shock of stability in rate cuts, or even the parlor game of rate increases? We're nowhere mentally near ready for that, are we?
I think we're mentally ready for a pause that lasts throughout the course of the year. Okay. I think there's been, even before the CPI report, you had only a little more than one cut priced in. Now that's gotten pushed out. I think that is the parlor game because a data-dependent Fed and added to that the policy uncertainty to say, yeah, we're confident that the Fed's going to cut in December. That's just a fool's errand to do that. I think you're absolutely right, though. I don't think the market is prepared if the Fed feels they actually have to turn back into tightening mode. Right.
I want to go to nominal GDP. Jason Furman's essay, the new foreign affairs is lights out. Stephen Levitsky with a great article. David and I will talk about that in a bit. Furman, taking a look back, 2020 hindsight on the Biden administration, and Liz Ann, he mentions nominal GDP. If I get a higher or stable inflation component, do you model out ample real GDP to keep the corporate animal spirits going?
Well, I think nominal GDP is important. That feeds into revenue growth, which is a little bit more correlated to things like employment trends and also pricing power. So I think it's the volatility in the inflation component that matters a little bit more than the level because of the uncertainty factor that creeps in when you're in an era of volatility in terms of that deflator. Right
now, reporting on Twitter with a real job. See, Sonders has an entire team to do Twitter. She hasn't done a tweet since Led Zeppelin announced their summer tour. Catherine Jones out on Twitter with Schwab, oof. CPI up, overall up, core up. Not what the market was hoping for. That report, David Gura, from Kathy Jones.
Well, you've given me a great segue here because I know that Kathy and Liz Ann have a podcast together on investing, and Rich Clarida was on that most recent episode. He won't return our calls, but he was on with them. What did you take away, Liz Ann, from what he had to say about inflation? What was the headline from his commentary on how he's seeing inflation today?
There's a tremendous amount of uncertainty, and adding in the policy uncertainty makes it a difficult exercise. There certainly is a slight bias on the upside, and there's the stickiness component of it, but he's no longer at the Fed. But I don't envy the folks there. Powell coming out yesterday saying we don't take that into consideration, but we know some Fed members are taking that policy uncertainty into consideration and trying to gauge their own outlooks.
As we wrap up here, I go back to my first question to you. That is just noting the fact that this isn't reflective of what we've seen in this new administration. We've talked this morning all week about the kind of inherently inflationary policies we could see put in place here, chief among them the tariffs policy from this administration. How do you think about that vis-a-vis inflation going forward here and how that's going to color this market in the months to come?
Well, if we go to sort of the maximum end of what's been proposed and then infer what that means for inflation, you can look at data out of folks like Peterson Institute. You're talking about a close to a 1% jump in inflation, but that is really not it's a step up in prices more so than a trigger for ongoing year over year or month over month higher inflation rates. I think, though, that's important because consumers tend to think in level terms, specifically what were prices back in 2019 pre-pandemic? What are they now? So it is important in the sense that the average person thinks in level terms, whereas folks like us get into the weeds of month over month and year over year and core services ex housing. So I think the level step up is going to be felt, even if it doesn't translate into an ongoing higher inflation rate.
Lizanne, just give us a pro tip here. Where are you able to buy eggs right now? Where is Lizanne Sonders buying eggs? I really want to know.
At the supermarket. I pay what I need to pay for eggs.
That's it.
Pay what you need to pay. There you go.
$14 a dozen.
I haven't gone out and bought my own chickens to hatch my own.
No free-range chickens.
Go to the market.
Yeah, Lizanne Sonders, thank you so much. To pick up from where Lizanne was, Gina Martin Adams, if we get inflation, is it a constructive inflation that can solidify revenue growth across the Bloomberg intelligence world?
It does look like we're going to see revenue recovery in the index, though the pace of revenue recovery is probably somewhat grim relative to expectations. I think that the really big key to 2025 is not that we continue to recover. It's that we may not be able to recover at the pace that is expected by the equity market. There's this really interesting dichotomy in the equity market right now, as you're seeing it play out real time. And that is, we're expecting not only very strong revenue growth, very strong earnings growth to emerge, but we're also expecting the Fed to cut. And that environment is inconsistent. And so that's why you see the market react so negatively to CPI. But also, when we look at the average price reaction to earnings growth, when stocks are reporting, even when they're reporting beats, their price reaction has been fairly grim. So I think we've got to work that dichotomy out. We've got to work that friction out of the system. The market's got to get more rational expectations and also generally get in line with what the Fed is doing. And the Fed is saying, we're on hold.
Can you help me? This is a dumb question, but I note the dichotomy and wonder why it's persisted as long as it has. So Tom asking a very good question. Are we going to hear anything different from the Fed chairman today? We heard him say yesterday a lot of what he said at the last press conference. He's been sort of reading from the same hymnal over and over and over again. Right. How has this dichotomy persisted, and what's going to be the catalyst that gets the market to kind of move away from what seems like a fool's expectation that there are going to be cuts in the near term?
Right. I think it's a great question. And I think the dichotomy can be explained by what's happening in the segments inside the equity market. So the greatest expectations really are centered around AI, tech, TMT industries, where we've seen the greatest degree of earnings growth. These also tend to be less inflation sensitive groups, right? They're more thematic. It's all based on AI and our anticipation of AI really changing the productivity outcomes for the world. And that is deeply embedded in tech expectations. We're seeing those expectations reverse somewhat, especially as a result of DeepSeek, but we've really seen tech expectations in a process of rationalizing since June of last year, when Mag 7 peaked in terms of their performance relative to the S&P 500, but it's just slowly getting dismantled. People aren't really giving up on that. At the same time, the rest of the market has been very slow to recover. And the rest of the market outside of TMT industries has really started to count on the Fed getting their back, enabling that recovery. So that the two-story, two-speed market is still a big story into 2025.
Gina Martin Adams with us here off the inflation report with the VIX out over 17.05. I want to emphasize, folks, out on Twitter, the series of charts from our guest, Kathy Jones. We were just busting her chops. She does brilliant work at Schwab, and she's got a wonderful chart showing the inflation stasis since the kids went back to school in September. Michael McDonough owns the high ground on this. Everyone in the industry uses Michael McDonough's colorful bar charts of the makeup, and it's just as simple as this, David Gura. McDonough goes right to the Gura index, supercore CPI month over month, is a spike up, but further than what many people expected.
I'm noting here, just as I think about all of this, and Tom, maybe you want to pick up on this, as we were talking about sort of what Fed Chair Jerome Powell might have to deal with. We've talked about the tweet from the president this morning, and we've seen this Fed chair so expertly, Tom, bat away suggestions from reporters, outside analysts, that it could kind of succumb to political pressure. Safe to say this makes his job much more difficult. That tweet this morning, coupled with the inflation data today, makes it harder still for this Fed chair to weather that kind of political storm.
The political, absolutely. And the question is, we know this president's beliefs from his business career, and it was only a matter of time till we got the kind of tweets that we got today as well. Gina, do businesses, can they adapt and adjust? My core theme is corporations always adapt. Can they adapt given a leveling of inflation and not a true disinflation?
Yeah, I think it's a great question. And what we tend to see is that really depends upon the degree to which producer prices accelerate. This, I think, is the crux of the problem for corporations right now, is at least until this data point, producer prices were accelerating at a faster pace than consumer prices. Producer prices, of course, are littered with energy products, but also industrial goods. Sort of those core imports are a huge an input to ultimate company costs. So it really is not just necessarily about a deceleration or stabilization of inflation, but it's the difference between the cost that they're paying for inputs and what they can charge the consumer on the other end. That's been working against them now for 2 months. We'll see over the course of this week if it continues to work against corporate margin outcomes. But it is a very different climate than we've been in for the last 2 years. Admittedly, we not only had disinflating inflation, but we also had producer prices decelerating faster than consumer prices. That was the idyllic environment for corporates. We're moving past that. And so you should expect a period of give and take at the very least to emerge. On top of that, you've got a lot of business uncertainty right now, even in small businesses, which vastly celebrated the election post-November, have started to pull back expectations because they don't know what the rules of the road are. Gina, and so we need some stabilization in policymaking to help enable growth there.
We got to run. Let's do this again. Let's get her in the studio again. Gina Martin Adams with Bloomberg Intelligence, brilliant on double-digit earnings growth. David Kelly scheduled to be with us here with J.P. Morgan, but we're going to squeeze this in right now as best we can. Again, futures at negative 56 off the CPI report. The VIX was a 17 level. I'm going to call it stasis, but a huge yield reset. Out 9 basis points on the 10-year yield, 4.62%. I watched the 10-year real yield, as Kristy Akullian does at BlackRock, 2.13% as well. Joining us now from BlackRock is Kristy Akullian, head of iShares investment strategy. So do you go home and blow up the year view because of higher inflation? Are you going like, why am I here? I got to go back and rewrite 40 pages?
Well, I'm certainly wishing I was on 20 minutes ago and not right now. I'd say, I think that, we came into this year pretty bullish. We've been overweight U.S. equities, but I feel really good and confident about the places that we've chosen to allocate to within that, as opposed to just broad-based. So we've been talking for a long time about the need to stay up in quality. We've been staying away from small caps. What you saw in the inflation data today is that it's on a relative basis, at least. It's those higher quality companies that we think can outperform. Small caps are going to face the headwinds of higher exposure to those higher interest rates.
What is, when you and Gardy, when you're at BlackRock, they're on speaking terms. When you're at BlackRock,
I hope so.
She's my boss.
What is the marginal appetite for equity ETFs right now? Is every day like, OMG, the money's coming in? Or are people scared stiff?
No, I think people are still very much allocating to the equity markets. It's been an incredible year for fixed income as well, so that's been certainly breaking records. But one thing that was so interesting to us is that even in a 25% positive year for equity markets last year, we saw 3 times more money allocated to cash funds, so money market funds. So we still think there's a lot of money on the sidelines. We're still talking to investors about putting money to work. And interestingly, even though we saw growth underperform value in January, we saw one of the largest spreads in terms of allocation to growth ETFs relative to value. So people are still convicted in this market. They're still convicted in the AI theme. Again, we just think that it's important to do so in a high quality way. So something like QUAL has been one kind of our top ticker of choice.
What is it?
QUAL is our quality ETF. So it's an equity market, sector neutral. You get the top quality companies.
It's like 80% the triple leveraged all cash fund. That's how you do it. I talked to Larry about it. It's in registration.
Gina Martin Adams a moment ago was talking about this different environment that, what we'd seen here in terms of an idyllic environment for corporates is changing. And I saw you nodding out of the corner of my eye. How do you see that challenge manifesting itself here in the months ahead?
Yeah, absolutely. And certainly it is an environment where we see and expect to see a lot of uncertainty. And uncertainty, as we know, is bad for markets. It can be bad for consumers. It can be bad for companies. But we're still really grounded in what we're seeing in terms of earnings. So, broadly, I think the macro picture still looks positive and that growth is still really strong. Corporate earnings have come back stronger than expected. So we're really focused on those fundamentals.
Tell me about leverage. I keep bringing this up. I make jokes about it, folks, but it's not funny. Leverage kills you. And the answer is it's all the rage right now. Double leverage, triple leverage, Mag 7, whatever. What do you actually see from people buying or selling leverage? And also, what do you see in your research?
Yeah, it's not a space that we play. So, we are not in the triple record.
Why don't you play triple leveraged?
We think about the appropriate nature of funds for all types of investors. So we like to launch institutional quality funds that can be used by end investors and direct investors as well. So again, we're focusing on portfolio building blocks, not necessarily trades. So that's just not our space.
He's trying to get his triple leveraged all cash fund in your portfolio.
I saw Larry.
I'm trying to talk about
I saw Larry on Fifth Avenue, and I said it would be a perfect BlackRock product.
Yeah? He's thinking about it.
What did he say
He said he's going to go think about that one. I do hear still a chorus among managers and advisors talking about small caps. This is a moment for small caps. Are you singing from that hymnal? Are you in that chorus as well, or are you steering clear?
We have been pushing back against that for a while, and I think the modal question we get from investors that we speak to is now finally the moment for small caps.
Yes.
We saw and sort of anticipated we were going to get a short, sharp rally after the election, but it wasn't something that we wanted to chase. And specifically, we didn't want to chase it because we think the fundamentals are still against that trade. So small caps are more exposed to higher interest rates, and also they tend to need accelerating growth. And even though we think growth is going to stay positive, we do think it's going to decelerate this year. So the sad answer for a lot of the folks who we see, a lot of the positioning data that we look at, investors are very overweight small caps. We still don't think that it's the moment for that just now.
This is brilliant. We got to have you back here when it's not absolutely nuts like
absolutely.
It is now. David Kelly with us here in a bit. Kristy, as simple as I can, the Mag 7 in the love here, are people buying at the margin, or is there a new test here to the Mag 7?
I think investors are looking for the broadening out trade, but they're still looking for large cap growth. So, again, we're not seeing as many flows into small caps, not into index value, at least. I think there's opportunity in the active space. But, when we look at the composition of returns last year from 2024, we saw about half of the S&P 500 returns were due to earnings per share growth, so fundamentals, and half was due to valuation expansion. If you look at large cap growth, 80% of that was driven by fundamentals. If you look at value, it was less than half driven by fundamentals, and small cap, 0 of it driven by fundamentals. So again, people are following the earnings, people are following the growth. We like the corporate profitability story, and we're staying a bit away from small caps.
Are you based in New York?
I'm based in San Francisco.
It's better there. I've heard.
At least the weather.
It's a new trend. Can you get us good Giants tickets?
Yeah, absolutely. You come visit. I'll take care of you.
So we're going to go first to Little Rock, to French Hill's minor league stadium, and then go see a Giants game in San Francisco.
Pop on over.
All right,
San Francisco's back.
My friend Carl he went to every major league stadium.
Yeah.
That's so cool.
Over a summer?
Yeah.
No.
Yeah, I think it was
several
over,
summers.
You don't want to come in the summer. September is the sweet spot for September.
Early autumn.
Kristy, thank you. Don't be a stranger. Kristy,
thank you so much for having me.
With BlackRock as well. Right now, the VIX 16.83.
A lot more red on the screen, if I can tee you up for that.
You nailed that. I mean, my word, Gura, equities, bonds, currencies, commodities, just absolutely nailing it here. But yields are higher, seriously. The 10-year yield out 9 basis points. I'm going to get right to it now. What we're going to do here, this is so important, we're going to blow out the show open and the song ending here. We had Nickelback tuned up.
I know, you
David
teased that.
Kelly or Nickelback.
I feel like Liz Ann Sonders succeeded in getting us to scuttle that.
And David knows where I'm going on this. When David Kelly and I met, we were younger, to say the least. And one of the great moments of this bull market and the oddities of equities, bonds, currencies, commodities is there's not a lot of people with bull market experience when it ends. David Kelly joins us now with JP Morgan. I just can't say enough about the team he's put together there of thinking responsibly about investment. And you were weaned on this in Boston at Putnam. Mm-hmm. You and I have tattooed to our soul the collapse of the Putnam Voyager Fund. Yep. It was the go-go fund. Now, I'm going to suggest, David, we don't have that exuberance right now, that I don't see it. But what's the radar you and your team use so that we can avoid the Putnam Voyagers of this decade?
There's a very old saying that you don't make the same mistake twice. The problem about the family of mistakes is a very broad family, and there's always some cousin or relative of the mistake you made.
A lot of inbreeding
that's actually a quote from the book Reminiscences of a Stock Operator, which
everyone should read every 5 years.
Exactly. But if you look at the mega cap tech companies, it's not the same thing as a dot-com bubble, of course. But you still have very high valuations, and you've still got and you've got more concentration in the S&P 500 now than you had back in the dot-com bubble. So there are bubbly aspects to this market, and the market is priced for perfection. And then if you have an imperfect number like the CPI number today, then you take a shellacking. And the thing that gets hit the most at the end of a bubble of a bull market, bull markets end up being bubble markets, is the thing that is the area that the bubble was concentrated in, and that's the thing that's most important here for people to think about. It doesn't, markets will come, bear markets, bull markets will come and go, but you don't want to be overweight, the overhyped at the peak of a bull market, and that's what I think investors need to think about.
I keep coming back to this, and we've talked a lot about the Fed being data dependent versus data point dependent. Yeah. How do you view the data that we got today in kind of a wider, more holistic lens? We see the reaction in the markets thus far, but what does it tell us that we didn't know yesterday or a week ago?
Actually, not as much as you'd think. The thing about when you have a surprise on CPI, people forecast CPI pretty well because all the core things are pretty easy to forecast. What causes a problem is the usual suspects, and the usual suspects are auto insurance, airline fares, hotel rates. So hotel rates were up 1.2%. Airline fares were up 1.4%, and auto insurance was up 2%.
These are all things that Tom has been complaining about at length in recent weeks.
I priced Paris last night, and versus 12 months ago, I'm spending $2,000 more. Yep, that's a fact.
Yeah.
From X to X plus 2,000. I mean, that's what he's saying.
He's not staying at the Hampton Inn.
Well, yeah, and it's a
he
difference.
He has his own inflation gauge that he follows.
That's a wealth effect. We've both been doing this long enough that, it used to be wealth effects and consumption weren't that important. Right. But there is so much wealth right now relative to 20 years ago, 30 years, 40 years ago, that when you have a wealth surge like we did last year, rich people spend money. And what do rich people spend money? Taking trips to Paris.
Ah.
That's where your problem is.
Joining us here at the hour top, David Kelly of JP Morgan. This is so important. We're going to forego the festivities of the market open. We forego Nickelback. That was my pitchers and catchers thing. You should have seen the
even harder to dispense with that than the show
tickets
open.
At Fenway Park years ago.
You went?
Kelly would be down. Peter Lynch would be backed up 12 rows back, and Kelly's down by the third base dugout. It's the rock star seats. David, I want you to talk about the moment we're in and how people scared participate in the equity markets. JP Morgan has this huge platform of a measured approach within a new media frenzy you and I didn't live years ago in Boston.
Absolutely. And you've just got to watch valuations. There are plenty of things in global equity markets which have got perfectly reasonable price tags. There are just a few things which dominate U.S. markets which don't have reasonable price tags. And you've just got to be determined to focus on, I'm going to buy stuff at reasonable valuations. This makes sense, both U.S. stocks and international stocks. And I'm going to try to do everything I can to underweight the stuff that is carrying PE ratios of 30 times or 35 times or 120 times. You just need to do that. We don't. You never know the hour nor the day that a bull market breaks and you end up in a bear market. You just don't know how to time that. But you do know how you position yourself before that really determines how you're going to go through it. So, overall the economy looks good, but we've got a lot of policy uncertainty. The problem is the equity market is priced for perfection, and or part of the equity market is priced for more than perfection. You just need to be underweight that.
I'll show my age here, but does a bull market end with a bang or a whimper? Customarily, you said you'd know the day or the hour.
That's a really sophisticated question. Seriously,
no, it ends with a bang. Uh-huh. I'm sorry, it's not going to just wimp out. We're past the point where the market can simply slide back into a bad year or two. We're going to have a significant bear market at some stage. We don't know when it's going to start, and you don't want to not participate. Just don't participate in the stuff that looks obviously crazy in terms of valuations.
David Kelly with JP Morgan. How do you fold in Kasman and Feroli's work? Michael Feroli making history, I'm going to say a decade, 8 years ago, with a shocking potential GDP number under 2%. Mm-hmm. Do you work off of JP Morgan economics modeling still a disinflationary tendency? John Williams yesterday reaffirming a path back to 2%.
Yep.
Is that a foundational call still?
I agree with them on that. I look at their stuff very, very, very closely. We work independently, but I agree with them on that, because if you look, yes, we got a surprising number today, but if you look at Shelter was 4.6% year over year last month. It's 4.4% right now, and it's still too high based on what we know is going on in the rental market. Auto insurance, saw a 2% increase, but it's double-digit year over year. It's not going to be double-digit year over year by the end of the year. So that part will go away, but what I am concerned about, and I think the Fed is concerned about, is what happens if we have more tariffs? What happens if immigration gets much tougher? You've got higher wages, and what happens if we have fiscal stimulus in 2026? And that's what's keeping the Fed more nervous. 30
seconds. Every single parent I know wants their kids to go to school in Europe. It's the new rage here. Mm-hmm. Sell Trinity right now. Everybody's looking at St. Andrews this, and go down to Paris, and the Rome and all that. The real academics is in Dublin, isn't it?
Well, you actually have a pretty good time there too. But what's a college education really about? And you will learn a lot about life in Dublin.
There you go.
David Kelly there with wisdom on his Dublin. Thank you so much with JP Morgan. This was a real treat to have him in here.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
I got a script with Huw van Steenis, like a plan. Like if he and I are in Davos, we have a plan. We go see Barry at the piano bar, and life goes on. The president has just gotten in the way of my script. President Trump putting out moments ago a tweet, interest rates should be lowered, something which would go hand in hand with upcoming tariffs. Let's rock and roll America. So I got to start with that.
Let's rock and roll America.
Joining us now, the king of British rock and roll, Huw van Steenis, encyclopedic on banking, and of course at Oliver Wyman, is well. Can a president force rates lower, or Chairman Powell speaking this morning?
Gosh, that's a great question to start. I was happier on the skiing than this.
Yeah.
Look, I think central bankers like to move at their own speed, don't they? And they ought to like to move incrementally where possible. So I think it's going to be tough. Look, tariffs. I think the market's still pricing in that they're going to be small and surgical rather than broad-based. If that's right, they're not as inflationary, so that you can see as inflation comes down, there's an opportunity to cut rates further. Look, if I think about it from the bank CEOs and CFOs I talk to, they're actually having a really good moment. They're in a purple patch.
Why are they in a good moment if the rest of us are in chaos?
Well, it's a really great question. So look, we've got a steeper yield curve, so they love that. Deposits are building up, so they got better funding. The credit environment is still really benign. There's very few bankruptcies, and actually with the Basel rules being kicked either into touch or certainly being what I think of as a bureaucratic fudge, if there's going to be bank capital neutral. I mean, let's be clear, BKX is up 43% in the last year. That beats FANGs. In fact, you would love this, that European banks are up 47. The European banks are being rehabilitated. You have to come back to Europe to talk about them sometime.
David Harrow, they off life support out in Chicago.
Out in Chicago.
Get a question in there. Gura, get a question in here.
As we get our popcorn and watch the second of these 2 days of hearings, no doubt there will be some questions about Basel III and capital, and as Jay Powell persists without Michael Barr, the other Michael Barr by his side. What does the future look like when it comes to sort of the regulatory remit of the Federal Reserve? What sense do we have of the contours of that post-Michael Barr?
It's a great question. Look, so Tom and I have discussed before, if we look back in 2 years ago, what went wrong? It was a failure of supervision. It wasn't actually a failure of the rules. It was just they weren't being implemented and followed. Out in California. Yeah. The 4 banks which went bust, but certainly the first 3, there were just people looking somewhere else rather than looking at proper good old-fashioned risk management and kicking the tires. So the supervision really needs to be improved, and I think there's some work ongoing, and you could say FDIC needs to be part of that. I think the thing I learned was that the big banks are in great shape, and so actually you don't need to bolster them with copper, gold-plated, platinum-plated, crypto-plated, regulation. But maybe there's a little bit of tightness around about the smaller banks. Maybe the regional banks do need a little bit more supervision. So I think it's quite incremental. And I think we're getting back to sanity after this 19% proposed increase.
I had a question for French Hill, the congressman and chair of the Financial Services Committee. Didn't have time for it. I'll put it to you. He talks a lot about how regulation is preventing de novo banks from coming onto the scene, that he doesn't think there are enough kind of smaller community banks. Are there too many banks in this country? Where is the need for even more banks in the U.S. banking system?
Look, so I think it's true stateside, but the world over, heavy-duty regulations have forced smaller banks. It makes it much, much tougher to start up. That said, in the States, if you think about the banking system, we've got your top 18, 24 banks who are in pretty good shape. Then you've got sort of close to 3,000 community banks. They sit on one of 3 computer systems. They actually have scale, because they're drag and drop on a really high quality platform. It's the belly in the middle. And so in fact, the 2 years ago, it was the belly which the 4 banks got in trouble. Yeah. Okay. That's where we need some M&A.
Let me frame this, like, for those of you across America. Gert, your question was brilliant. Why do we need to lean forward here? Huw van Steenis came out of Trinity at Oxford, PP&E, and had to get a day job. So he went to Morgan Stanley, where he was definitive on banks in Europe, but worldwide as well, and took down trophies like 12 years in a row or something. They had to force him out just so somebody else could win the damn trophy. He's worked with Mark Carney at the Bank of England as well. But to your question, is definitive. Trump loves Andrew Jackson.
Yes,
I mean, is that where we're going?
The portrait is back up on the wall. Yeah. I know, in the Oval Office, but I don't know if you want to talk about Andrew Jackson. You should feel free if you want.
Well, we can if you want, but you should get Neil Ferguson on. I mean, I think what Neil always taught me, and actually I had dinner with Dick Berner last night, who you may remember, the chief economist of Morgan Stanley back those days.
I think I owe him money.
Oh, yeah. Well, Dick's on great form, and I'm sure he'll take that. Yeah. But so he said, look, the key lesson is that these clever PhDs, they haven't done economic history.
Right.
And actually, we learned that in the financial crisis. So actually, whether it's Jackson or whether we actually go back to the 19th century and actually, think about the impact of tariffs, about current account surpluses and deficits, history really matters. I think Neil's a better guess than me on that.
No, this is really important. And to Richard Berner, folks, at Morgan Stanley, who was Stephen Roach, changed American economics. I think Dick Berner and I are on this forward guidance things, folks. You hear me talk about the dot plots. McKee and I are like, are you kidding me? And the answer is maybe they'll go away. A lot of that came from the excellence of Richard Berner. Huw, I got to rip up the script here. We have a glorious person at Bloomberg Intelligence, Robert Schiffman, who writes on debt and credit in MAGA. He has just put out a brilliant note suggesting that all this angst about capital raise there could be done with debt issuance because they don't have any debt and they make more money than God in free cash flow. Do you think the bankers like you used to be will convince MAGA that raising that capital is an easy process because of the wonderful financial position they're in, and they can raise billions in debt?
It's a great question. So look, let's stick on the bits which I have confidence, and let's move to the trickier bit.
Please.
It's raining fixed income at the moment. The inflows to fixed income, I think this year last year was a record in the States. I think it's going to be a new record based on what I've seen in January and early February. So it's raining fixed income. The demand for yield is huge. And I think the way to put it is, after 20 years where people didn't look at their fixed income portfolios, the last 3 years it's come back. So the demand side's there. But as you've debated tons of times, the structure of markets has changed a lot. And so it's going to be ETFs or it's private credit. And so there's a hollowing out. So I think the demand, I think you could issue plenty more debt.
Okay, so take a round number, $100 billion, 6, 7 companies. In the old days, you'd sit at Morgan Stanley and there'd be like 4 phone calls, right?
That's right.
Can they do $100 billion in debt with 7 phone calls? And the answer is yes.
They could do, but it's not necessarily the banks taking it down any longer. It's actually the investor side which is taking it down, because the banks don't have that kind of capacity.
Fair.
Or to at least to sit on it at least.
Oh, come on, sovereign wealth.
Well, but I think, hang on, let's go back to history. So when Neil and I were chatting, this is a recycling of petrodollars. Why is it that everyone's in the Middle East? It's because those dollars need to find a home. And actually they are funding the states. And actually that could be one of the windfalls of the next 4 years, is actually the recycling of these petrodollars.
As Tom Venmo's Dr. Berner, let me ask you about how what we've heard from Mark Rowan and his cohort lately is resonating in the C-suites of the big banks on Wall Street. His ambition to grow private credit and to sort of present himself as this, not even alternative, but sort of driving force for financing. What are banks doing in the face of that to compensate or compete with what he's saying?
Look, so it's fascinating how many banks now are prepared to accept there is a partnership model rather than just a counterpart. I think there's 2 ways to slice it. The traditional private credit business is higher yielding. It's leveraged finance, mid-market finance. And the way I think about it is that there's a retranching or reslicing of the banking system. The senior risk is being taken by the banks and the junior risk is being sold. And I think I've said to Tom, I almost think that private credit's the Ozempic to the banking industry. It's helping them shed weight. But, and here's a big but, the risk now is the private credit firms are raising so much insurance money. Over half of all inflows to private credit last year, I think, came from insurers. Well, we haven't got the final numbers yet. They need investment grade. So there you're now getting into the territory of the banks. Private credit only has about 5-6% share of that asset-backed lending.
Right.
And that's where they're going next. And that will put them into more confrontation with the banks.
This is chilling. It's like talking to David Goldman when he was at Bank of America in like 2006 or 2007. To translate this, folks, and Huw, help me out here. If private credit is going to pick up the pieces from the major banks in lesser quality, what are called junior tranches, is there an implied leverage within those tranches? I mean, are they pure and clean, or is there a shadow leverage within the new system of private credit and, frankly, private equity that we don't see?
Look, this is the number one question from regulators. You've obviously been having dinner with a lot of central bank governors. This is the number
you're
one.
With Richard Berner. I had dinner, folks, I had dinner with Jerome Powell last night.
Exactly, of course you did.
Surveillance disclosure,
But no, that's a great question. Actually, the Bank of England is doing work on exactly that issue. What's interesting, though, is if you think about the insurers who are putting money to work, they need investment-grade assets.
Right.
And that's about 43%
unleveraged, pure and clean.
They don't do, let's say, NAV finance, so fund finance. The insurers do none of that. That's all being done by more the other parts of the ecosystem. So even if there is leverage, it's in sort of hands which are prepared to accept risky bets rather than the low-risk bets. So there is a kind of,
Okay.
Like in a way, I always think in life, we need the right holders of the right risk. You know, in a way, what we learned from, let's say, GE Capital, they had long-dated loans, but with short-dated deposits. We want long-dated, exactly. So we need to parcel out loans, parcel out the risk to the right owners.
So go to the x-axis, which you're expert on. In private equity, they have not been able to liquidize previous investments. Yeah. Are you optimistic private equity can monetize their successes this year and into next year, 2026? And does private credit, will they have the same challenges of getting out of this stuff once they get into it?
Oh, it's two great questions. So
it's a hat trick of great questions.
You guys worked this out before.
Exactly. So this is my script, obviously, wasn't it?
It's a lot of rehearsal.
Exactly. It's tough. So all of the bankers that I talked to, we're in November, we're jumping for joy about a huge IPO calendar for this year.
Exactly.
Haven't seen it, though.
Maybe they did it just in time for bonus season and they were talking it up. But
Shonali Bassick sat there yesterday and said exactly the same thing. I missed that.
I'm so sorry. Okay, I will credit Shonali with that. But obviously now they're saying in February, it's okay, but it's a bit slow, and it's that indigestion in the sponsor community. In fact, if you get some great data, if you look at M&A, strategic M&A, so like company buying company, is sort of more at average levels for the last 15 years. It's bouncing, it should be a little bit higher. Mid-market M&A, again, is in line. It's the sponsor M&A which is weak, and that's why the private credit side are having to strike out for fresh pasture. So I think, look, you know, markets are here to embarrass and confront us. As at always, the moment, it looks like it's going to be a reasonable but sluggish year.
David, get one more in here with Huw van Steenis.
Just ask you lastly about the kind of relationship between public and private and partnerships that might come out of this new administration. So we saw the scene in the Oval Office with Larry Ellison and Sam Altman and talk of financing a big data center project in Texas and elsewhere. Obviously, as we talked about and lampooned a little bit a moment ago, there is the speculation about a sovereign wealth fund here in the U.S. How do seasoned private sector professionals look at that and navigate these proposals that, you know, admittedly don't have a lot of meat on the bone at this point, but does the notion of a public-private partnership change under this administration?
Oh gosh, it's a great question. Well, look, in some ways, you do already have a sovereign wealth fund, if I might be so bold, with Freddie and Fannie. I mean, they effectively are
for now
cheap financing for the moment. Yeah. So I think you can do that. I mean, obviously, it depends whether it's through tax credits, through structures, how stable are the structures, what's the longevity of the partnership. But I think everyone's looking at this with it. You have an obligation to look at this seriously.
30 seconds, you came up with the phrase asset management barbell. Huw van Steenis on the ETF boom.
Oh, look, the fixed income ETFs are off the charts. Inflows last year in the States tripled on the year before.
What's the trap? It's a free lunch.
So the bit which is growing is like, let's call it active ETF. And it's the same discussion we had 20 years ago with, let's say, the PIMCO Total Return Fund. They're saying, I'll do the index and a little bit of Tabasco too. And the extra Tabasco gets you there. And last year there were two, I'm not doing company names this morning, but two funds who did really well in that space. I think that active ETF space for fixed income remains really interesting.
Michael Barr wants to know, do you use Tabasco on your full English?
No.
No?
I try not to.
Mrs. Van Steenis should be like, that's it, out the door. Huw van Steenis, thank you so much. Don't be a stranger.
It's been a real pleasure.
Really, with Oliver Wyman and Dan Tannenbaum, I should mention, just Huw van Steenis there. Brilliant on banks, and there they are, resurging European banks.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Tina Fordham has provided phenomenal transatlantic perspective over the recent years, and she's just continually delivered to us on international relations and how it folds into the markets. She becomes ever stronger, joined by Ebrahim Rahbari, who was at Citigroup and Legendary, and to have Fordham and Rahbari together today is really what Bloomberg Surveillance is all about. Tina, the moment that we're in right now, I assume your 5-page report has become a 20-page report. Distill it into one observation of how, whatever our political persuasions, how we survive this testing of an executive branch versus a legislative branch and a judicial branch.
Thank you for the introduction and the low pressure question. How do we think about these unprecedented times? We keep an open mind and we check our priors because we've never been here before.
We've never been here before, so how do you check your priors?
It's really important to constantly test your expectations, your confirmation bias,
right,
to seek a wide range of opinions, which is why I love working with Ebrahim, because he keeps me intellectually honest.
Well, this is great. Thank you for selling Ebrahim to us. I'm going to cut to the chase. The dollar is the prior. Is the great shock of what is to come with this Trump 2 administration a fragility or super strength to the U.S. dollar?
I think eventually it'll be a fragility, actually, and we've got a first taste of that over the last couple of weeks. So in the currency world, I actually think it points to that handing over to the yen as maybe the place to hide in difficult times. But as I said, and as Tina mentioned, many, many moving parts. So I keep it with Chair Powell, who we'll hear from later today. Be humble and nimble. Check your priors and try to work out what are the preferences and what are the constraints of policymakers along the way.
A question for both of you. I'll start with you first, Ebrahim, and that is during the campaign we heard a lot from Scott Bessent, among others, about the prospects of there being a shadow Fed chair who kind of telegraph what the next Fed chair would think or do. And I guess we're getting a taste of that this morning from the president. He's opining on X and Truth Social about these inflation numbers. Biden inflation up, he tweeted this morning. He suggested that interest rates should be lower before this testimony that you just mentioned. Perhaps he is the shadow Fed chair that was so teased during the campaign trail. But in terms of what's unprecedented, I go back to a question I asked Tom a few minutes ago, and that is, how much more difficult does it get for Jerome Powell to weather the commentary, the critique, the criticism, the politics of this moment? He's indicated over and over again that he's up for it, but this is going to become increasingly difficult for him.
So from my vantage point, it actually is getting significantly more difficult.
Yeah.
And we've seen that in Jay Powell in his last few press conferences. He used to be very effective in communicating, and he's become much less effective. And clearly the new administration is a big reason. But I also think it's because he holds a lot less effective sway over his committee. The committee seems to be a lot more politicized. There's a lot of talk about Powell being politicized, but I actually think it's other people in the committee, and on both sides. So you see some unnamed governors being significantly more dovish, and some people speculate if they're aiming to be his successor. But maybe more relevantly, there are a number of people who have tilted from being very dovish to much less dovish when we have had very little data to speak of so far. So I think it's a much more difficult environment. He's much less effective as a leader. Some people will speak of lame duck risk.
Tina, to that point, I mean, he's dealing with the same uncertainty that we are. He's going to field as many questions today as yesterday, perhaps more just about the tariffs policy, how that might affect the economy. He's going to try to bat that down, but there's going to be increasing demand for him to indicate how he's thinking through these issues.
There's a lot of pressure for anybody in a leadership role to both demonstrate their integrity, but also not be perceived as sending the wrong signal to this administration. I think it's important that we don't normalize this, however, because what we are talking about as we think about lower trust in institutions, that includes the Fed, that includes the courts, Congress was always low on that list.
Very true.
And for investors, that means that the non-linearities that are present in the system make it a lot harder to do what market participants like to do, which is say signal versus noise.
In our studios, we are thrilled to bring you this hour Ebrahim Rahbari and Tina Fordham of Fordham Global Foresight. I can't say enough. Usually in London, and to have them in our studios,
treat. Yes.
It is really, really a treat. Can I do an audible?
Yeah.
You are the one I want to talk to on this, in that we have a president going through a routine visit with the Hashemite king of Jordan, Abdullah II. Folks, it takes you back to the movie Lawrence of Arabia. The ignorance of America of where Jordan fits in to the matrix of the Levant is there's no measurement of how dumb I am and everybody else. I had a very well-reported interview with El-Sisi at Davos years ago. El-Sisi of Egypt said, "Enough, I'm not even going." Explain to Republicans now in support of Trump the delicacies of how the president is treating Jordan, Egypt, and the rest of the broader Middle East?
Well, it's consistent with a kind of an American approach to the world, which is get them in a room, knock heads, and make a deal. And so Trump's logic is very, very appealing. But other countries have politics too. King Abdullah of Jordan has 50% of his population is Palestinian. He can't simply roll over and expect to stay in power, and his presence in the region is very important for stability.
And he's been holistic for America from his time at Eaglebrook and Deerfield years ago in western Massachusetts. I mean, this is a guy that's always been on the American team. Is he the buffer to Iran? I mean, on the map, it tells me that Jordan is the buffer to Persia. Am I right on that?
I think Syria as a wild card and the kind of power vacuum there may be more relevant for Iran, which finds itself in a weak position. And what we don't know is what kind of discussion Netanyahu of Israel is having with the president and this move toward maximum pressure, and what that means. Because making it harder for Abdullah to sit on that throne, pressuring Sisi in Egypt, could cause what us political scientists call unintended consequences and make a difficult situation worse.
We're sitting here, Ebrahim's going, Tom, don't ask me about the Egyptian pound. Please, David, save us, please.
Ebrahim, just bearing in mind what we were talking about a moment ago, that there is so much here that's unprecedented and not normal, how useful is it for you to go back and look at the first term to sort of divine what might be happening here? Is this Trump 2.0? Is it a revision of the manual that we had that first time around, or is it simply a very different guidebook?
I think it's still very useful.
Yeah.
And in fact, the way to approach it is to think about what is similar to the first term and what is different. And I've continued to highlight that there are big macroeconomic differences. We are now in a world where the economy is robust, stock markets are at all-time highs, and inflation is a major concern. So that shapes how this administration will respond. It doesn't need to stimulate the economy. It will worry about inflation, and net, that means it'll be less fiscally expansionary than many people would have thought. But we've had a number of developments that are very much in line with how this administration worked the first time around. And I think the most relevant of them is it loves to experiment, it loves to take risks, it loves to send trial balloons, and it's very keen to reverse course. It likes to act first, see what the response is, and then adjudicate. In addition to that, it likes to, as Tina likes to call it, flood the zone, distract and maybe divide potential opposition.
Confuse.
So there's a number of, and confuse. So there's a number of lessons in the first term that I think investors and the general public would be, in a good position to heed.
Tina, we're seeing that now. There's this big confab that's going to happen in Munich in the coming days, the Munich Security Conference, and the vice president has gone from Paris to there. He'll speak there. I look at the Bloomberg and see a headline this morning. Ukraine NATO membership is not a realistic goal, according to Pete Hegseth, the new defense secretary. From where you sit, what is the next chapter of that conflict?
The steam just came out of her ears.
I mean, Ukraine joining NATO, I don't think has been a realistic goal. But Ukraine, with having a European perspective, as the EU likes to say, is a realistic goal. And that is an anchor for the European Union. I think, the military strategists like to quote the old saying that no plan survives first contact with the enemy. When Vice President Vance gets to Munich, he'll get an earful and be confronted with the European reality, because Russia's on our doorstep. We've got several NATO member states that are very concerned. This isn't just about creating a demilitarized zone in the occupied territories. If it were that simple, land for peace, it would already have been done.
What is your counsel to someone like me, someone listening who watched what unfolded yesterday in the Oval Office, Donald Trump talking about Gaza as a place that's not worth anything, it's his to buy, indicating there's been no thought into sort of where people there would go if this essentially ethnic cleansing were to happen, people were to be moved out. Not thinking through all of these steps, how much weight do you give to what seem like not thought out, perhaps offhand comments like that versus a broader kind of strategic bent when it comes to the Middle East or other places around the world?
Well, first of all, I think he's serious.
You think he is?
I think he is a real estate developer. He made similar comments about North Korea, right? About
Pyongyang
all this,
could be the next
Riviera. He sees, waterfront, oceanfront
How
property.
will Mr. Putin respond to that?
President Putin can watch and wait, just like President Xi, right?
Right.
Remember, we talked about this during COVID, they thought America was in decline, and they're just watching to see the chaos ensue.
Can't say enough about Angela Stent with her. She was on fire. Her book, Putin's World, she was really forceful about we underestimate Putin at this Trump moment. Ebrahim Rahbari, Tina Fordham with his Fordham Global Foresight, a generous amount of time, and we're going to continue. We welcome all of you across the nation and worldwide on YouTube. Subscribe to Bloomberg Podcast. I can tell you this is what the show's about. Catherine Mann nailed it. She went to the bank. She got sick of you guys. She got sick of you in Citigroup. Said, see ya. And Catherine Mann, who folks came up with the whole dysfunction of China, U.S., etc. Dr. Mann went to the Bank of England, and she has been a resilient, cautious hawk there. Is that the new tone, Ebrahim Rahbari? Is even with this inflation report, even the middle ground, or dare I say the doves, tilt hawkish over the next year?
Well, I think what everybody really appreciates about Catherine is, again, that she has an open mind, but at the same time, she is a very structured thinker. And what was catching my eye recently with her is she was an ardent hawk on the Bank of England's MPC for the last, probably 2 years. Mm-hmm. She was on the dovish end of the spectrum when I worked with her. Uh-huh. And then in the very last meeting, she seemed to flip back again and highlighted that there are some points of pressure in the UK economy that, in fact, pulled her into the idea that maybe they should be cutting by 50 basis points, when previously she was in the in the rear guard that suggested that the Bank of England should be very, very cautious. Now, the lesson in there for me is for somebody like her, who is not an internal MPC member at the Bank of England. Historically, they've been treated with a bit of a discount by markets because they're seen as less influential. I would say pay a lot more attention to her than you normally would, because it's times of great uncertainty. It's times when people don't really have much of an anchor, where these people have more influence.
I got to get this final question in honor of Willem Bouter, who invented modern Citigroup research. The debt and the deficit is tangible. Americans love to ignore the debt and the deficit. Ebrahim Rahbari, is this a time where we need to focus on the debt, the deficit, and our interest expense?
I think yes and yes, for two reasons. I think one is, the near-term one. This administration has actually focused on it. And again, I think people have been missing how focused they are on, to some degree, managing what they see as a vulnerability in terms of the level of debt and deficit and how much power they have. I mean, the standard answer you get from anybody on U.S. fiscal is, well, the executive can't really do very much. It's Congress's job. Congress is so dysfunctional and divided. We are seeing them taking action. They're trying to cut spending. They have a lot more power over Congress than previous administrations have had. So there's, I think, interesting fiscal action going on right now, which is different from what people expect. There's the bigger question that a lot more people ask about, which is, when are we entering the period of fiscal crisis in the U.S.? And there, I think, massive topic to watch, but that timing, if anything, is actually slightly pushed back relative to what we thought a couple of months ago than what people were expecting.
We're out of time. This has been
We'll
wonderful.
have many occasions to talk,
Can we
though,
make
if
this
past
like
is prologue
anytime
here.
you're in town?
Yes, but I don't have to be in town. But yes, I will be coming more often.
Okay,
We've
wonderful.
got the German elections.
Can
We've
you
got
do
the
something
tariffs.
about London hotel prices?
Oh.
I'd like to speak to you about New York hotel prices with my weak sterling.
It's unbelievable.
It's harder. It's harder than ever. But it's wonderful to have these conversations, and I think the appetite for this kind of open-minded, checking your priors, it has to be the way forward. We haven't seen this movie before.
No, we haven't, and we're working on it. David and I are reading as much as we can to stay up on this. Stephen Levinsky and the new Foreign Affairs, and Jason Furman, and of course, Tina Fordham writing every day. Tina Fordham, Ebrahim Rahbari, thank you so much for joining Bloomberg.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
After decades of service to his constituents in Arkansas, has the worst job in Washington. He has had a House Financial Services Committee, the Republican from Arkansas, and he joins us right now. Fritz, I got 8 ways to go here, but I got to look to the second, third week of March, where the challenge is a government shutdown, budget challenges. You're going to be in the heart of this. So I'm going to go to someone on your committee like Monica de la Cruz, the Latina from Texas. Fine. Okay, the conservative Southerns that don't want to budge on the budget, how are mainstream Republicans like you going to convince them to keep the United States of America running?
Well, Tom, this is such an important question. Great to be with you this morning. This is something we should have done in December, and it was a horrible mistake, in my judgment, not to complete the funding for FY25 in the previous Congress. Under the Biden administration, we would have had roughly the same characteristics. We would have had an incoming Trump administration, an incoming Senate. I think we would have gotten substantially the same deal. And now we're trying to do budget reconciliation, which is a much more important task, and yet we face, as you point out, a government shutdown. Republicans have to stick together. We should use the Fiscal Responsibility Act numbers from last year and negotiate with the Senate, now a Republican Senate, who wants to spend a little bit more on defense, and get this behind us so that we could go to the main event of focus on reforming regulation, reforming productivity in the federal government, reforming spending, extending pro-growth tax cuts.
Give us your sense of how much optimism you have that's going to happen here. I know there's a lot of nervousness and apprehension that time is running short. There are different views on this. We were spending the last few weeks talking about will it be one bill or two bill or three bills. I know you've been involved in the same game there on the Hill. Do you see a path forward here? How much clarity do you have at this point?
Yeah. Well, first on Tom's question about FY25, finishing FY25 before March 14th, I have medium confidence. The worst case scenario would be to continue a CR till like September 30th. First of all, once you hit April 1st, you'll have a 1% across the board cut in FY25 spending. And CRs are terrible for government management. We'll end up spending billions more because we operate under a CR. We won't be able to start any new programs at the Defense Department, which is a priority for the administration. So that makes me lean to, yes, we'll get something done on March 14th on fiscal 25. As to budget reconciliation, the big game, I do support one bill here in the House because I think that's how we hold the Republican coalition together best here. And as you know, Senator Graham in the Senate's taking a different approach.
Congressman Hill, what is the view from the Longworth House office building of what we're seeing the White House do? Of course, the historical precedent has been that Congress controls the purse, makes decisions about funding, and we are seeing this administration take a more active role, shall we say, in determining what gets funded and what doesn't. How much comfort do you have with ceding some of that power to your friends and colleagues in the other branch, the executive branch of Pennsylvania Avenue?
Well, I think you find on money that's appropriated, Congress does control those purse strings and they direct that spending. But in the broad swaths of federal spending, you have directions to agencies, spend this money on these general topics. And that's what the appropriated money says. And then you have Article 2 authority with a lot of discretion about how to spend it. And I think that's what President Trump's attempting to look at. Is the spending done at the end of the Biden administration and proposed to be spent here in the first few weeks of his administration? Is it in alignment with his goals that he has in foreign policy, for example, at USAID? And that's a classic Article 2 authority to take a look at that, make sure it's in alignment with their policies. With that said, you can't do these things without both the legislative branch and the executive branch ultimately working together.
Then, French Hill, you and I have known each other since time began, and I've never seen a private citizen in the Oval Office standing there with his arms crossed like he owned the high ground. You are one of the rare beasts that came to Congress actually running a business in Little Rock. What's your advice to your fellow moderate brethren of the Democratic and Republican persuasion? What do they need to do in the coming days?
Well, first, let's look at DOGE, Tom. It's a good idea to go in and look at for efficiency in government in the executive branch and make recommendations to the legislative branch when you want to spend money differently or have a different number of full-time equivalent positions in an agency. That's perfectly a good suggestion. And we haven't done it in years. I'd say since 9/11, the government's been focused on growing, not remotely focused on productivity or realigning or investing in technology or doing anything in a different way. We've been completely distracted by the war on terrorism, the 2008 crisis, and then the recovery from that, and then the pandemic. So I think it's overtime to scrape the barnacles from the ship of state when it comes to regulatory policy, personnel policy. But there's a right way and a wrong way to do it, and I would encourage the administration to plan, communicate, and consult with Congress on how the best way to do that is.
As for the right way to do it, I think of you as a young man serving as a Deputy Assistant Secretary in the Treasury Department under Nicholas Brady, and I wonder if you could have imagined you would have non-appointed, non-confirmed private sector individuals going in and looking at the payment system there in the Treasury Department. Does that make you uncomfortable, having the history that you have with the Treasury Department, to see the way that DOGE has been approaching the sort of fiscal health, the books, for lack of a better word, of the federal government?
Well, when I heard about that story over the weekend last week, I called Secretary Bessent. We talked about it last Monday, and he assured me that anything that DOGE was doing was in the control of the official Treasury Department, and that some people were working there for IT review purposes. But he implied to me that he's got that under control for making those recommendations. We're going to hold him accountable. He's the Treasury Secretary. So anything that DOGE is doing in a cabinet agency, we just need to remind the American people, members of Congress, the Trump administration, we're holding the cabinet secretary accountable for, as I say, planning efficiency changes, budget changes, personnel changes. We're holding them accountable here in Congress.
We got some news overnight that Jonathan McKernan, formerly the FDIC, has been picked to head the CFPB, and this has been an agency that's been in the crosshairs. I think it's safe to say you've had your criticisms with that agency over these last few years. And I want to ask you about some comments that the gentlelady from Cambridge, Massachusetts made on our air last night, the senior senator from Massachusetts, Elizabeth Warren. And she said, look, it's not up to the executive branch to decide whether or not an agency like the CFPB exists or what form it takes. That's up to Congress. And the point that she's making is, you and other lawmakers, if you don't like what this bureau, this agency is doing, you could take action yourselves. Lawmakers could decide whether or not it should continue to exist. Do you agree with the argument that she's making there, that fundamentally it's not up to the executive branch, not up to this administration to decide what agencies, what parts of this government should stick around or be disappeared?
Well, as a general matter, you'd have to look at statute by statute, agent by agency by that. But as a general statement, sure. I mean, Congress creates agencies. Congress can end agencies. There's nothing so permanent, though, as a temporary government program, as President Reagan reminded us. But let's talk about Elizabeth Warren. She's the founding mother of the CFPB. She created it to be insulated from oversight, insulated from appropriations, and insulated from any meddling by Congress. And that's what's irritated Congress, and that's why I support changing the agency dramatically.
But French Hill, I got a couple final questions. This is important, as you mentioned, the senator from the Commonwealth. Where do we find a middle ground? You are one of the leaders of the middle ground in Washington. How does Senator Warren and someone over on the MAGA right find a common feature around people like French Hill?
Well, it's a great question, and I've urged Senator Warren to consider that exactly. She's concerned about the big banks taking over the world. Well, she's created that with Dodd-Frank. It concentrates more power into those big banks. I've encouraged her to consider tailoring policies for all the rest of the banking system, and also considering compromise on the CFPB by putting it under congressional appropriations and having a bipartisan commission that oversees its work. Those are middle ground points.
French, I don't care. Here's what I care about. My father worshipped Bill Dickey of Little Rock, Arkansas, the ex-Yankees, million years ago. Your minor league ball team, the Arkansas Travelers, Texas League, they play in the Dickey Stadium. How's the state of minor league baseball in Little Rock as we have pitchers and catchers today?
Boy, strong. There's no better place to be on an early summer night. The price is right, the fun is great, and it's fun to beat the teams in the Texas League, and it's something I love doing with not only my family, but all my friends.
There were the Seattle Mariners. You think I could see the Red Sox, down in Arkansas.
We got to make every time I fill in on this show, we have like 3 trips we need to take on the heels of each show.
We do that.
Little Rock for some baseball sounds like a good plan to me.
We'll put you right behind home plate, Tom.
Oh, I love
French
that.
Hill, in honor of the beloved Barney Frank, I hope you do as well as Barney Frank. He's head of the Financial Services Committee in Washington, the Republican from Little Rock. French Hill joining us.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.